Hello everyone, welcome to Moll Wendén Law Firm and to the term sheet battle in Malmo. Thank you. Great. Give it up. This is a startup and entrepreneur event. Naturally, we want to use the brilliant startups of Malmo and Öresund. So we're broadcasting this live via Bamboozer, Malmo startup. Worth an applaud. We're also recording on camera. Welcome, my name is David Klose. I'm a partner here at Moll Wendén. We're going to put on a show for you tonight. I hope you'll enjoy it. I hope that everyone will get a seat, at least the ones that don't work here. We have at least 2 or 3 seats here in the front if someone has had enough wine to dare. Some of you may have been here before at Rapidus or something similar. Some of you may not know us at all. We are a law firm based here in Malmo, providing full service advice to businesses in Malmo and independent of size, really. But we do have a special eye to the entrepreneur and startup community. And we've been partners with Malmo incubator MINC since, well, the birth of MINC, really. MINC is also a co-sponsor of this event, and I think that many of you know MINC. We have Dag and Matthias in the audience from MINC, and we have, I see many familiar faces from MINC. Congratulations are in order to MINC. MINC company Saplo won the Rookie of the Year award only this Monday in Malmö Näringslivsgala. So it's second time in a row. With Hövding winning last year, you've managed to show that for 2 years in a row, MINC is really strong and important for the region. I'd also like to congratulate Beepsend, of course, who is also in the audience. You won the Businessman, Businesswoman of the Year award. And I loved your speech. It was great. I hope the water doesn't break here either. We have additional partners, and one of the main reasons for having this is to show that it's not only possible, but it's also important to have Danish and Swedish participants in the same event. Because if we want to truly create a startup community, an Öresund startup community, we have to do it ourselves and together. So that's what we're trying to do. That's sort of as a goal today. I hope you will join us and make an effort, really. So I'm happy to say, although we're a little bit afraid of the Danes, they make it more exciting here in Malmö. You saw how Alex here, he was, wobbling around with the computers and stuff. That's typically Danes, but you're welcome anyway. I'm really glad to have, as a co-sponsor tonight, Startup Bootcamp with Alex here. Startup Bootcamp, Alex and Brad, you're going to explain a little bit more about Startup Bootcamp and how the term sheet battle came to Öresund. But it's an equally successful business accelerator from Copenhagen. You're going to talk more about that later. What else? Well, one goal is to interact, and another goal is, of course, to learn something about investments and VC thinking. I hope we will provide you with that. I know that there is massive experience in the room. A lot of you have experience from the entrepreneurial side or from the investing side. I hope that you will share your experiences as well and listen to what the cast have to say. Please don't be afraid to ask questions, because this is not an easy subject. I'll try to make some mistakes so that you can feel comfortable in making more mistakes as well. All right, before I pass the mic over to Alex, I'm going to say that we have an international or US-based term sheet tonight. The reasons for that are many. First of all, Brad here has wonderful statistics from the US market that is simply not available for the Swedish market. Another important issue is that it's not at all unlikely that your companies will attract foreign investors. We have on stage today living proof of that. Entrepreneurs who have attracted, at least once, American, Canadian, and what else? Investors. to startups from this region. We also have an investor who puts his money where his mouth is, I think. It's great.
I hope so.
So, one last thing, as the big man said. You might come to hear 1 or 2 bad lawyer jokes tonight from the cast. We let them do that. We just want you to remember that this is all an act. All right, Alex.
Okay, I'm just going to take 3 minutes to introduce Startup Bootcamp, and I'll give you the background of why we're here. I don't have a clicker, so I'm going to be doing this a lot. My name is Alex Facet. An incubator is something that was invented to keep premature babies nice and safe and warm from the environment. We think that's perfectly the wrong analogy for what we do. We're an accelerator. We make it very uncomfortable for startups. We do 3 months of rocket boost and put them into orbit. What we do is we select 10 teams, and they relocate to our cities for 3 months. We give them free co-working space, some cash, mentors, and exposure on Investor Day. The secret sauce is the mentors. You actually have 3 of them right here. They're the ones who are bringing the real value to Startup Bootcamp. We have about 1 consultant, 1 professor. All the rest of the 80 mentors in Copenhagen are serial entrepreneurs. Our motto is a mentor a day keeps the doctor away. So it's incredibly interactive. What happens is, you can't see this, but this is a team pitching to the mentors. And then this is Richard Anson, the CEO of Review, who flies in from the UK to do a mentoring session. But most of what happens is this. It's one-on-one sessions working on real-life problems. So there's not a lot of conceptual stuff. There's not a lot of teaching, per se. There's doing. We finish with Investor Day, and this is where this is in November last year. We did Investor Day in Sterkast, and then the night before, we did the first term sheet battle with Jimmy, Tommy Allers, the CEO of Podio, and we had Brad. And the idea was to try and interact with the investors who were flying in for our Investor Day. And it was a bigger crowd, because we just had more room. I think we could have filled a room twice the size. And you're going to see, you're going to listen very carefully, because there's a lot of information flying. But basically, we're saying we're opening the doors to a process that's very mysterious. Most of us have never sat in, other than our own, investor negotiations. And we want this to be an open process, which is win-win. And now, most of the investors have most of the knowledge, because they've done this 200 times. Most entrepreneurs are doing it for the first time. And so we want to level that playing field. So I'll skip this. We're growing. We started in Copenhagen. We're now in 4 cities, and I'm about to announce one of these. In Copenhagen, we're hosted by Nokia. In Amsterdam, we're hosted by Vodafone. In Dublin, we're next door to Google and Facebook. So the corporates are excited about what we're doing. And that brings us to this. I did it less than 3 minutes, right? I kept my promise. So, yeah, the idea is this is as interactive as possible. Brad will tell you more about it, but I want especially the entrepreneurs in there. It doesn't matter, this isn't class, there's no bad question. Just interrupt, say, I don't understand. If you don't walk away having learned something, then we failed. Thanks very much for being here, and have a good night.
I hope I'm not the reason that we're doing this in English. I did ask the question, if we had an equal number of Danes and Swedes in the room, what language would we do this in? And I think that's when we got back to the battle, the whole Viking thing. So as a compromise, I appreciate the fact that all of you will accommodate me with my English language skills. My background is that I'm a securities lawyer, and I spent about 15 years as a lawyer in Seattle, negotiating, typically on behalf of entrepreneurs, but sometimes on behalf of VCs, a lot of startup financings. And some of those became big successes, went public, got bought, that sort of thing. Some of them hit the wall. And the background for the term sheet battle here really arises from a program that I helped put together through the University of Washington back in 1995. And at the time in Seattle, we had a relatively nascent or an emerging venture capital community in Seattle with just a couple, 3 firms, not a lot of capital, and there wasn't a lot of standardization or knowledge about how these deals would get done. And so I put together a program, really started out trying to educate lawyers. And the funny thing about it was the University of Washington Law School publicized it in the local business press, and we just had massive registrations from entrepreneurs. And it turned out that this became quite an event. We kept putting it on year after year. It was called How to Raise Startup Capital, or How to Raise Private Equity. And it went from about 1995 to about 2004, through the whole dot-com boom, which in Seattle was a big deal because Amazon is headquartered in Seattle, and there's some people in Seattle who invested as an angel investor in Amazon who made hundreds of millions of dollars. They started to recirculate that money back into the ecosystem. And so as the years went by, these deals became more and more standardized. And I would say in the United States, it's still not the case that, that it's a cookie cutter approach, but I think it is the case that because of the volume of transactions, the way early stage companies get financed has become pretty standardized. So then fast forward when I got here to Copenhagen, and Alex invited me to attend the Startup Bootcamp Investor Day. I was approached after that because I'm an angel investor. After I left the practice of law, I became an executive and an angel investor. And a couple of the entrepreneurs who came didn't seem to really have, in my view, a pitch. Not that they didn't have a pitch for the business was fine. They didn't really have a pitch for what they were trying to sell. Were they trying to sell me convertible debt? What, Series A financing? What was it? And that's when I think I called Alex and said, it occurs to me that maybe we could put on a program to try and educate people, not just the entrepreneurs, but also the community, about how these deals typically get done. And for me, I've learned a tremendous amount about the difference between how deals get done in the United States. I think in the United States we're a little bit imperialistic with how we try to export not just the culture but also the way we do deals. And when you get over here into Scandinavia, you have a lot of very successful companies, and the way they do business in, say, Denmark is a little different than how they do business in Sweden or the UK or Germany, so on and so forth. So this program is about an education process, I think, for all of us who are involved on the panel. And hopefully for you as well. Now, one of the things, I guess before we get too far into this, I'm just curious demographically, how many of you out there would call yourself an entrepreneur? Pretty good. And how many of you would call yourself an investor? Okay. And then how many are service provider or other? Okay, so it's a pretty good mix, but it sounds like we've got quite a few entrepreneurs. And so one of the things about the fact scenario that we have, and I hope all of you did get a chance to read it, is that in this case we've got a company that's incorporated in Delaware. So having said all that, I guess I should introduce the cast. We have Hampus, who is the CEO of Boxes of Beauty. Hampus is, in our fact scenario and in life, a serial entrepreneur, a good bet who came up with a good idea, assembled the original founding team, went out and began to build the business, was successful not only in getting accepted to the Startup Bootcamp program, but also at attracting a sophisticated business angel who also is a serial entrepreneur, Carl Sibowski.
Sophisticated.
Thank you. So Carl came on board in October of 2011. In November of 2011, the Boxes of Beauty team got up and started boot camp and did a great pitch. It was exciting. A lot of investors showed interest, one of whom is Jimmy. Jimmy is one of the founders of Sunstone Capital, which is one of the really well-known and active venture funds here in Scandinavia. And so Jimmy and he unleashed the team, and there's been several meetings at this point on Valentine's Day, which it turns out is Jimmy's birthday. The term sheet is like any VC financing in the United States. It's pretty complex. What we're going to do is talk about the 10 or 11 issues that people tend to get excited about, which are the control issues and the economic issues. And we're going to take each one seriatim. So what the team will do is negotiate. They're going to spar and duke it out a little bit. And then at the end of each issue, what we'll do is kind of do a pause and then talk about what really happens in the real world.
Guys, good to see you again.
Thanks.
We had a good session with my partners here a couple of weeks back. And my partners was so excited to see what feedback you would have. And now you have been waiting for 2 weeks. So term sheet is running out. 7 days left. They already took 2 weeks. It's Swedish, I think. Consensus.
Well,
But it was actually the lawyers we try to find.
Yeah.
I mean, it's so hard to get good lawyers. I mean, it's incredible. I mean, it's
That's why we ended up having this meeting
exactly,
without any
exactly.
lawyer. I guess.
Yeah.
Jesus Christ, it's costing me just thinking about it.
yeah, exactly. They actually charge for that nowadays.
They do?
Yeah.
Oh wow, amazing.
Sorry.
They do
Yeah.
think? Oh, okay.
Yeah, yeah, it took some while to go through this material. It was
But we'll sign today, right?
We will drink wine. We will perhaps sign later on.
You know, but it's an interesting agreement. I mean, there are definitely parts we like about it, and we also definitely see issues. I guess we should just, I mean, if you want to just start from the top, or do you have any clauses that you feel that are most important for you that you want to sort of focus on? Or?
I know the term sheet. You tell me what you feel is important.
Yeah.
Oh, great.
Okay,
Let's
sure.
start off. Let's kick off with the. Should we kick off with the pricing? That we. Can you just take us through the pricing one? How you set up the pricing and the pre and post money valuation, etc.
The pre-money valuation, I thought we agreed. You asked for 6 million pre, even in our meetings, and I delivered you a 6 million pre, which, by the way, Carl invested half that price 4 months ago, so he's
at
making
an
a lot
amazing risk, I would say.
Absolutely.
We've gone forward. Amazing. We've grown as a company.
yeah,
as I said.
But
absolutely.
I think the progress of the company has not been that big in those 4 months. But
No, interesting.
at least,
saying that.
at least if we look at the 150,000 samples that is closing down to maybe 250 samples delivered now and 250,000 members, we are a little concerned to see if that's really the ramp that we're envisioning. Or
I mean, I think that with beauty, I think that there's it's a very season-based business. So I mean, in sort of spring, there's a sort of massive season. I mean, this is my second company doing a beauty product. So I mean, at our old,
could tell,
I mean, our old company that we was just, I mean, when we set up Pure Cosmetics, Cosmetics and People. I mean, we saw May, June, July. It was, I mean, in a massive ramp up. So I mean, I think that we kind of actually waited and didn't want too many investments during January because of the sort of slow season. So I definitely we see that too, that it's sort of slow.
January is slow.
Yeah, definitely. I mean,
It's a clear hockey stick. It goes like this and then it goes like this.
Yeah, absolutely.
Okay. But you tend to agree that 500,000 is what you will reach, right?
Yeah, I
During-
think that. I don't think that's going to be a big
That's
issue.
why I put that in the milestone. So
Yeah,
I just take you on the word.
It's in the forecast,
Yeah.
and
Okay,
we could over-deliver on that one. So that's why we shouldn't put it in the milestone. It could be very uncertain numbers at this point. But of course, as soon as we get visibility of those numbers, I think we should communicate them with you guys as being an investor in our company.
As soon as you have visibility, the higher the pre-money, of course. But as long as you don't have that visibility, and it maybe there's seasonality and maybe it's not.
But if we have visibility of overreaching those one, we should adjust it now, the valuation, or upside, or?
I'm taking the risk of investing now, so why should I give you upside on the risk?
Why should we give you the lower side of those numbers?
I mean, I'm here to make a return on investment, right? And if I'm doing sort of a little bit of math on my return on investment, I mean, this is the pre-money that I can offer you.
I think that what we kind of understand that. I think that it kind of depends on on other parts of the agreement, of course. And I think one of the things I think on the last meeting we had, I think that when we talked about the goals and then, as you said, milestones, that was one of the things we were surprised on seeing on the term sheet, that we thought that would be. I mean, part of it would be that you would put Janet, the contact you had, in our board, and as sort of you talked quite a lot about Janet and her experience in this.
We still will do that, I think.
Yeah, but I think on the tranche, putting that on the milestone, that feels like that's partly dependent on Janet and her delivering too. So it feels like, I mean, for me, it felt like
a lot of inputs on those numbers.
Yeah, it's partly yours too. So. So if we could sort of put part of that and sort of say that it depends, of course, on performance of board members appointed by you guys. And
I don't think so.
How quickly we can access the capital.
That was a good one, though. Hadn't heard that one before.
You haven't heard that before, okay. Yeah.
Performance of the board member. That
Yeah, but I mean...
okay.
They should be evaluated continuously.
But I mean, the way
of
we
course.
understood Janet, I mean, she seems to be the superstar for me. So
Janet is cool. Janet is cool.
But on the trenches, I mean, one of the issues with actually having trenches for us is the seasonality. Because of the summer coming, we would like to have as much war chest as possible to be able to accelerate this. And sort of the trench, that we kind of understand it, but we would like to put the larger amounts sort of closer to us and sort of have a sort of smaller second tranche, if that is okay.
So the way it's done now, it's a 50-50. So
Yeah.
And originally, remember that you asked for only 1.5, and now I'm offering you 3. And now you want more than the 1.5 now. For which reasons? Do you need more cash than you believed, or?
No, but we kind of understand why you're doing that.
I mean, I just looked at the budget, and 1.5 should be more than enough to bring you through the first milestones. At least what you said. That should be a walk in the park.
Did you get?
And you said you would even overshoot them. That's why I kept them at the lower numbers that you referred
But did
to.
you get our expansion plans as well attached to the budget, or?
Your expansion plans?
It was in the but it was maybe he didn't. Of course, you need to read attachments, so came with that. So of course, expansion plan was going much faster in certain countries. In the countries we picked, of course, the big launch in Germany, of course, and the big launch in was it Netherlands you were going after as well?
It depends. Flanders,
Brazil
actually.
is
Flanders.
Yeah, exactly.
Brazil
That's
is
sort of a focus
then
country.
Brazil, of course, and that's going attached, of course, with the budget. So,
But of course, I mean, we could take it slower. I mean,
yes.
So I mean,
let's keep the
I did this.
competing
I mean,
companies.
Guys, how much do you want up front then?
I would like 2 actually.
Let's see a number.
2.5. I think it's
2.5 and then 500 milestones.
I would say 2. I would find 2
Two,
because
two,
2
okay.
and then 1. I think that's
2 and
perfect.
1.
Yeah, I would think that would.
Okay, and what milestones should we then put on the 1?
We originally had 5,000, right?
5,000?
500,000.
500. It must be the strong coffee.
I'm not okay with 500. I just gave you another 500 to invest. We get more acceleration, you said. I mean, Brazil, Flanders, and what have you.
Should we split it up? So I mean, let's say if we reach 250, we're at half, and we give 500 80%.
No, it has to be higher than 500. That was the milestone with the low investment.
So should we put it at 600? And then if we reach 300, we get half.
What acceleration are we talking about? I mean, it doesn't sound like acceleration to me.
No,
Now you're active in Sweden, partly Germany, and you're talking Brazil and all. It's a big
Brazil
country.
is an interesting country. But so in the numbers we're anticipating to reach the milestones. Yet we not want to be in a situation upon sitting on speaking to Sunstone immediately after closing this round and saying now we reached the milestones and now we think we're going to reach the milestones. We think we need to have sufficient kind of funding in order to continue on with our plans and to have a clear path forward.
That's why you're asking for 2 now instead of 1.5.
Exactly.
Right, but I'm talking about the milestones on the last 1 million.
Yes.
So we should put them more aggressively, right?
I'm okay with 600. Are you okay with 600?
600 is nothing. I mean, that's not expanding.
I think that we will reach those numbers with the traction we have today. No doubt about it.
I think it's slightly too optimistic. So I mean, are you okay with 600?
Yeah.
I'm okay with 600 if the CEO is okay with 600.
Yeah, great. Yeah.
It
The
seems,
CEO is
that,
okay
it
with
seems that the chairman is more optimistic than the CEO.
That's the kind of angel investments you get these days.
He's exactly. That's angels for you.
Okay.
So on the dilution, there.
Oh, it does work.
What dilution?
I mean, that's one of the issues we're having because I mean we're sort of we kind of see this as a double dip with the options.
Okay.
So,
but you need people to perform your.
I think that
expansion plan, I suppose.
I mean, our employees did do. I mean, they are a lot of.
But how many employees again?
Now we're 26, depending. I mean, full-time equivalents. They return 26. So. And I mean, most.
And how many people do you have in Brazil and Flanders?
No, nobody yet. I mean, we have great contacts. I mean, Carla has some really good people that he knows, and Flanders actually I know some personally, but Carla is sort of we're looking at Brazil.
But you want to put them on an incentive structure?
Yeah, I mean, but
how many people do you expect to be in a year with your expansion plans?
I think that 35 within a year. I think we're
35.
I think we can keep the operation here and just have
triple your revenue with 35.
Yeah, that's the thing. That's why we thought it was a good deal. So I think that stretching it to 40. I don't think we need more than 40 people.
No.
I mean, it's distributors mainly. This is a channel business. I mean, it's
But the stock option plan that we are suggesting is pretty common. I mean, you don't know what's coming.
Yeah, but it's double dipping we dislike. I mean,
so we have 4.25% today in the option pool towards employees.
But they already already allocated.
So
they're allocated.
There's no unallocated stock.
No, so but they are vesting over 4 years. So you want to keep.
So you plan to fire some of your employees? Or?
No, so we're adding on less than 65 people, less than 65% more employees during the time, as Hampus said. So we're saying that we should 5 times almost our current option pool. It doesn't make really sense. Why is that common? I don't understand that.
We usually have a 20% total pool, and this is a 20% total pool.
But on what grounds do you say 20%?
Usually, companies that are expanding this quickly is having a fairly large pool to hire a new talent.
But we're already an attractive brand. What should we do with the 20%?
You're already an attractive brand or attractive
company and an attractive brand.
I think if you're going to exceed the plans that you just showed, I mean, you need more staff. Maybe 20 is high. We can discuss whether 20 is too high, but that is pretty common. That over time, from now on until the exit, we want to make sure that we have enough room.
So
it's not. I'm not thinking only the next year forward. I'm thinking.
Okay. So what's the recent kind of size?
That's usually the size we see over a 5-7 year horizon. Is enough to allocate. This is still a young startup.
But we expect in another 4 or 5 years, another 2 years to bring in another second round, Series B round.
Yeah, but then then at that time you will decide what is the pool. And then maybe if we have already the right pool, then everybody's happy.
So if you say, what do you suggesting that the pre-valuation of the investment is 2 million? What is the pre-valuation is 6 million.
The fully diluted pre is 6, and assuming that we invest 3 now in 2 tranches, 2 and 1, it's going to be post money of 9 pounds. I'm from UK, so it's
exactly.
pounds.
So it's pounds. Yeah, sorry.
So,
we are the effective valuation.
We're okay with that actually. I think that's fine.
Yeah,
I think that's
cool. Yeah, okay.
Then it's done. Price.
No, yeah, but I think as you're alluding to, I think the issue is, I mean that would put you at 30%. But
33.
Yeah, 33. Exactly.
33. Yeah.
Exactly. Good point. But I think that one of the things we're looking at there, which we see as double dipping, is you're looking at introducing the option pool before the investment.
Yes, of course.
Yeah, but that's definitely going to push down. I mean,
it's a fully diluted pre of 6.
Yeah,
but post of.
Yeah, I think that.
So what should the option pool be?
I'm fine with 20, but I think that should be, looked at post.
So I should take the dilution of the options pool that.
We take it together. That's what we do. I mean.
I would like to do that before. Then we can discuss what you think is the proper size.
But doesn't that bring down the valuation of the company then?
It's 6 million for me, because that dilution I'm going to take anyway later, when you issue the stock, and when they exercise. So what I look at is just what I get out of the exit. So I assume that dilution will come anyway.
So you're saying that we take the 6 pre plus the dilution of 20% stock option, the option pool.
We can debate whether 20 is too much. That was what we put in, because we thought that looking ahead 5 years with your plans, I would have speculated that you would be 300 people, and big organizations, some of the key employees. Maybe 20 is too much. I don't know. Maybe it's Sweden, or maybe they don't take stock options here in Sweden. Or
I'm going to jump in here. So this is an interesting point, because the valuation issue, the pre and the post, is obviously impacted by the number of shares that are included in the option pool. And if you look at Exhibit B, pre and post financing, the number of options that are currently outstanding is 300,000, and the number that are being requested to be put into the pool is another 976,000. So the question is, at whose expense should those options come? And if they're included in the term sheet the way it's drafted, then basically it's coming out of the hide of the founders. so there's a give and take here, but in my experience, typically the option pool would include reserved shares, but the real question is how many shares are required in order to get to the next financing, which let's just assume it's 18 months or so. So I would just be curious, maybe Jimmy, you want to talk about, how far into the future you're hoping this pool to be available?
Well, only until the next financing round, of course, not to exit, because it's always going to be renegotiation at the next rounds, as they also alluded to, these gentlemen. And also 20% is pretty high of total pool at this stage, as what we usually see. So it must be revenues ventures that are on the way here. So usual is probably around 10% total, or maybe 15, depending on, if you have an organization already with 20-some people and most of the key staff is there, and it's only 35 people. I was assuming 200 here, right? Then I think a total of 10 to 12 should be fine. And if already 4 is there, it's basically you need to look at what's the hiring plan and what are the number of key staff, right? That's at the end of the day what you have to look at.
But actually, it is in our interest too, of course. Definitely a nasty thing is when you have a too small option pool as an entrepreneur yourself, because it might be an issue for...
What you hate to see as a VC is you just invested the money and then suddenly all the unallocated pool is already gone. And then you have to... then it's a different deal. You have to wait to do that until the next funding round, right? So that's plus 18 months or whatever. And not to exit. That's a stupid argument.
So in a nutshell, just on a cheat sheet basis, if you reduce the size of the option pool, then all it really does is reduce the price per share. I'm sorry, increase the price per share. No, wait.
Yeah.
That's right.
Non-diluted pre is going up.
Yeah. So the cap table at the end, it's just a mathematical formula. It's not a big deal. If instead of it being 976, you say, look, I think we can get by with another 300,000, then all these numbers would just be recomputed, and the percentage ownership and the price per share would be recomputed. So I think we spent enough time on that particular issue. The one that we talked a little bit about was the tranched financing and whether that is mandatory or whether that's optional. Tranche financings are something that come and go a little bit. I would say they're a little more common today than they were a couple of years ago.
Brett, before you go on to that, entrepreneurs comment here. If the VC is asking for too high a pool, don't try to go counter and make too low a pool, because of course much lower pool is having less dilution immediately. But if that is not enough, and you have to have the discussion with VC prior to the next funding round, then you will be squashed. Then you will see much more dilution. So you have to find the balance between the two intervals. And what we usually see is 10 to 15, right? But don't go too far the other way. That won't fly.
Right. So on these this tranche financing, Jimmy, do you want to talk about that in terms of? I assume in your case you would want it to be optional. I assume in the entrepreneur's case they would want it to be
mandatory.
Callable, so to speak.
Yeah. In this case, it is a pure milestone-based solution that was offered, meaning that assuming that it's objective milestones and we agree that they are fulfilled or not, then the money would be called, and in most cases the investor would also have a put. That's what we see. So we say even though the milestones are not there, for some reason we would like to put the money anyway and have that stake we aim for, the equity ownership we aim for. So it's rarely a call from the company or from the firm.
On the milestones itself, part of this, the assumption is that the entrepreneurs are pretty confident in their plan, and they went to Ravenous Ventures and was saying, okay, if you give us $1.5 million, this is what we can do. But I'm just curious, does it make sense to have milestones, particularly milestone 3, where the company has achieved profitability? How often would you see that for a Series A finance company?
Rarely. So I guess that could be the VC's escape clause.
Right. Yeah, I mean, companies can choose to become profitable if they scale back their marketing expense. If, on the other hand, the goal is to increase the membership base, you might continue to spend money even if it's not profitable. So it's one of these things where it's in here mainly to elicit discussion.
So with milestones, what you usually want to do is, if you can, avoid it.
Yeah.
And usually if entrepreneurs is coming to the VC full of excitement and they are adamant about how much growth they can achieve, and therefore they want the really, really high pre-money, as in this case, debatable whether it's high, then of course what the VC will say, I'll take you on the word. So if you can deliver that, you'll have your price. Problem is that if they actually end up being too optimistic, and most are, because entrepreneurs are a little bit more optimistic than VCs on average.
Do you think so?
And definitely than
I
lawyers.
know so.
And definitely than lawyers.
Just need a copy of the term sheet.
Lawyers is a completely different ballgame. But then maybe say, okay, let's discuss that pre-money again. So maybe we're not that high on the pre-money, and then you avoid all the milestones. Because at the end of the day, in this term sheet, you have conflicting milestones. So one will go for growth and one will go for profit, which, I mean, they don't go hand in hand necessarily. And that could be just an escape clause. So if it doesn't really turn out as the VC expected, the VC only invested the 2 million, which I agreed to, right?
Yeah, and I think that as an entrepreneur, I think that I completely agree with what you said. That it's definitely a common thing to see if people are very optimistic. You put milestones there, and I think that as an entrepreneur, I guess you got to see those as bonus money, because I mean you can't depend the company on it. I mean you can't sort of expect the milestone to be reached. I mean, of course, you can hope.
You can lower your risk if it doesn't work.
Yeah. So.
Or your exposure. You can lower your exposure as a VC.
Yeah, exactly.
If it doesn't work, right?
Yeah.
So it's better to negotiate pre-money. Many things in this will be much more simple if you can just agree on the price. Then everything gets a lot easier.
But
and a lot of these other things, at the end of the day, is just discussing price.
Yeah.
It's just another way of discussing price.
But before this meeting, I mean, the common way is that you normally always go, but you need to show us some growth. You mean Google? Is that enough? That's a typical kind of VC kind of. You want the founders to say that, stick their neck out and say like, yeah, I'm going to do double-digit growth for the next 10 years.
Yeah, and then
so it's then you're trapped. So you never say like, I'm going to grow, above the market in a decent size for next continue on growing. In the past we have amazing growth. We're going to continue that path, etc., etc. But never ever say how much growth we're going to deliver. Which I think
these 5-year plans with the first 2 years that are very flat, and then comes the hockey stick.
But this was, I mean, with milestone-based, this is a classical thing we did with doing license agreements. Because when you do license agreement with customers, royalty-based or subscription-based, customers usually want to have as low subscription fee as possible, of course, and then they promise high numbers. And of course, what you do is you just put milestones on it and say, sure, I mean, if you reach 50 million devices sold, that of course you get that. Let's put that as a milestone. Yes. And then people go like, oh no, we think 10 million devices. It's like, oh, then the royalty is much higher. It's like, oh, 50 is okay. Shoot, we're going to sit there with this nasty milestone. So
then you're trapped.
Even pros, I mean, biggest do that.
So we're going to move on to the next slide, which is liquidation preference. Before I do that, I'm just going to describe some of the fundamentals, because while I'm sure a lot of people understand this stuff, for some in the audience maybe it's jargon, but the idea behind venture capital financing in a Delaware corporation is that there's common stock, and that's the stock that was originally issued to the founders, and it doesn't have any special rights or preferences. And then in this case, there's going to be an issuance of what's called Series A preferred stock. Preferred stock has preferences over common stock, and those things can include liquidation preference, dividend rights, redemption rights, conversion rights, voting rights, blah, blah, blah. We're going to get into some of those other things. And then with respect to why is it called Series A versus, say, Series B or Series C, typically each series has the same rights and preferences within that series, but if you go into a Series B can have a different rights and preferences, both relative to the Series A and relative to the common. And one of the things we're going to talk about next is liquidation preference. And what that means is that in connection with a sale of the company, the preferred stock would typically get a preference prior to the common participating. So for example, if there was a 1x preference and the company is sold for, in this case, let's say $3 million, and let's say that they had gone through and raised $3 million, then in that case, the Series A investors get 100% of the proceeds, and the common gets 0. Even though, in this case, the preferred only gets, quote, say 1/3 of the equity, because they have a preference prior to the common participating, they would get their money back first. So we're going to talk about, how that works, so on and so forth. So why don't we jump back in, and I'm sure Carl has some questions why Sunstone would get preferred stock when he just got common.
Exactly. That's an interesting aspect of it. So, exactly. Can you please explain that? Why is the situation?
Nice cue.
I knew you would say that. Well, you paid half price 4 months ago. I want some protection. So therefore, I would like to have a...
You want some protection?
Yeah, I want...
Okay, let's say the protection is 2 times liquidation preference. Plus some bit more.
Yeah, the usual dividends.
Of course, yeah.
Yeah.
So, but that's okay if I get that as well, or?
I mean, we are in here to make a nice return on investment, and that's what you also promise. And we sit here because we believe in it. Obviously, a lot can go wrong, and you might come to the conclusion that we should sell the company at a lower price. We just want to make sure we make a decent return on our investment. And this structure is ensuring that we make a decent return on investment.
Yeah, but it doesn't give me much comfort, does it? I also want a good, decent return on my investment.
How do you want that?
2 times liquidation preference. Is that okay by you?
Ask the founder.
We can't sort of change the stock right now.
Nah, that's true.
Strange. I think that it's... I mean, I would be okay with giving... I mean, changing the stock then and sort of doing 1 times liquidation preferences for all. So
exactly.
Yeah. So for Carl's stock too, if you would be okay. I mean, if you would be okay with having 1-time liquidation preferences.
No, I mean 1 time is not at a low exit value. That's not going to give. That's going to give us a very low percentage return. So 1x is not enough.
I mean, we kind of understand. I mean, we're here to build a big company and make a lot of money.
So and then if it's a big exit, it doesn't really matter in the end.
No, I think that in that sense, I think that I think that's a good point. And I think that are you okay with having we're looking at if you get like a 3 times return, you would have a kick out on liquidation preferences, because as you're saying, it doesn't really matter if it's a big exit. I mean, if you make 3 times your money, it's like, who cares about liquidation preferences?
Yeah, we can talk about capping that. We mostly want to protect our downside at a lower exit level. So we can discuss scenarios of that kind.
Yeah. So 3 times kick out, for example.
Yeah, as long as we get participating preferred after 3 times.
If you get preferred after 3 times?
No, participating preferred. As long as we participate after we get the 3 times.
And I think that I think I'm fine with participation rights, but I think we got to have pay to play there. I mean, if you don't participate, you revert to common stock.
If I don't participate, what do you mean?
I mean, if we have a second round, then we bring in a sort of big fish investor. Yeah. Then if you don't participate, then your stock would convert to common stock, because I mean that means you don't sort of see the
that I could not live with.
But then you don't believe in the company anymore.
I invested, assuming that we invested 3 million. I want to return on the 3 million.
But that's in your same situation as I am.
Yeah,
right
exactly.
Now,
so that feels weird.
Why would that make any difference?
I didn't negotiate your deal.
No, but we are negotiating your
deal.
deal.
You have to talk to this guy. I mean,
we are negotiating your deal now.
No, yeah, but that's not my problem.
But then we come in the same situation. So it'd be better to have me on liquidation and like have a lower liquidation preferences, and or perhaps just have a cap your with a kick out, wouldn't it? I think that's a great idea.
I think kick out feels fine with me, because I think
no
on the
kick out.
downside, I think
we're not going to accept kick out, but we're going to accept that the 2x is going to be lowered at a certain level.
So you want to have both. You want to have both sides here. You want to have protection downside and full upside.
Yeah, downside I can understand. I can understand that.
But if you want downside, then you also should have.
If you have the upside, then it feels like capping that makes much more sense.
I'm a VC. I don't like capping anything. I would really like the upside.
I'm an angel. I like it.
Yeah. And I mean, as I think we all see that this is going to be a big return. So I think that doesn't really matter. I think that in that sense. So I think a 3 times kickout would be doesn't. I mean, we're not going to sell for a let's say a 100 million offer. We wouldn't sell anyway.
So how would that work exactly? So tell me your model.
I would say that when you made 3 times return of your money,
Yeah.
the rest. I mean, then after that, then the liquidation preferences would be. The rest would be seen as common stock. So.
So all the way up until I have 3x, I get my 2x.
Yep.
And when we have across that, I get participating preferred as common stock.
Yes. Just as common stock.
Yeah, we can discuss that. We can discuss that.
Okay, that's great. And
I just want to jump in here. Right now, the term sheet has a 2x liquidation preference.
Yep.
And so what you just negotiated was a 3x.
No, but did we?
Yes.
Yeah, you just gave away.
No,
the
we gave it
farm.
3x kickout. That's
It's
what you
3x
said.
kickout.
3x kickout. So that was the same.
What does that mean?
But I mean,
Look at that. That's
what we're after is really that when they get 3 times their money, they're just seen as common stock.
Okay,
So
but where did the 3x come from?
What do I mean? 3x is okay. So that's when you want participation rights. I guess that's the problem. Ah,
I get
okay.
that, I
So
get
that
that.
part I missed.
You just gave me a 3x.
No,
my
no,
friend.
but yeah, we're gonna replay that.
I was just so surprised by
No,
my
I-
pen. I got a calendar there. Isn't that amazing?
Okay, hold on. We have a question.
Can you explain what is a kickout?
Yeah.
So my point of making here is that if we do actually do a good return, I would like to get rid of his liquidation preferences. So if he gets 3 times his money back, I want to see his stock as common stock. And as 3 times his money back is not that much money actually. But what I missed was that he wanted to have participating rights, so that doesn't actually matter. Then actually,
He got caught.
Exactly, I got caught. I got caught in legalish. That's why
Yeah.
you shouldn't have lawyers at all involved. You should do everything on like napkins. So. That's my 5th.
Much better deal.
So one thing I think it's important to conceptualize here is that there's, let's just assume that it's what the term sheet provides, which is a 2x liquidation preference. That means, in the scenario that I gave before, if the company was acquired for $6 million and $3 million had been invested, the preferred would take 100% of the proceeds. What's happening now is they're talking about when does the preference go away, and that's a concept called capped preferred, so that once the venture investor has received a certain return on investment, let's say it's 2 or 3x, then they no longer have a liquidation preference, and they would have to convert to common. So the real question here is, do you get both? Do you both get your money back first and get to participate? So for example, if it's a 2x liquidation, let's assume that the company was acquired for 10 million on a 2x liquidation. In this case, there's 3 million invested, so the preferred would get 6 million first, and if it could participate, it would get 1/3 of 4 million. So in that case, the Series A would get 7.3 million.
Now I get 9.
Okay.
Plus a third.
And so that's the concept. And I would just say, everything is negotiable. I did a little research on what's happening in the Silicon Valley, and there's a study that was just released a couple, 3 days ago on what happened in the 4th quarter of 2011. The amount of multiple liquidation preferences has gone way down from 29% of the deals having it in Q3 to 13% in Q4. Right now, it's a pretty good environment to raise money as an entrepreneur in Silicon Valley. And with respect to the amount of the multiple, whether it's 1 to 2 or 2 to 3, interestingly, in Q4, apparently there were no 1 to 2x multiple liquidation preferences done in the Silicon Valley. This is 130 deals analyzed. But of those that did have multiple liquidation preference in the Valley, 75% had a 3x, which I think is kind of bizarre. I think there must be a statistical anomaly.
We want to stick to those numbers.
But the long and the short is that the venture investors will get obviously the first cut of the money. Then the real question is, will they be capped at some point? Do they lose that? In which case they just get their pro rata percentage, 1/3 of the company, or do they actually get 2 bites at the apple? And you can come up with a lot of scenarios why it does make sense for them to get perhaps a multiple liquidation preference. And Jimmy, you might just talk about that, because there's nightmare scenarios, right, where the VCs may end up not getting much of a return on investment, and
I've tried that.
Yeah, and if you don't have these features, then there's a possibility that the founders might sell too cheap.
Yeah, so basically, you have 3 scenarios. You have the scenario where the company is gonna sell so low or almost go bankrupt, so it doesn't really matter, right? I mean, and then you have low exits where actually the VC might end up with the full exit proceed, which in practice rarely works, because the acquirer of the company would like to see an incentive structure for the retained employees, which means that you have to renegotiate. So even in the lower cases, it doesn't always work. You have to renegotiate anyway. But there, the VC, of course, start to renegotiate from a power position, because they actually own all of it, and now you have to discuss distribution. And that's the discussion between the VC and the acquirer of the company, usually. And then there are the scenarios where it's gonna blow away. It's gonna be a huge exit, or it's even gonna be a mid but nice exit in terms of value. And there you could say, then what the liquidation preference, especially if it's a 2x participating preferred like in this one, is just gonna give you a super normal return, right? It's gonna give you much more than the ownership, or not much more, but some more than ownership does, because you get the investment back 2 times, and then you participate as if you still own 33% of the company. So it's just it's a return increaser, if you like. So the debate to have with the VCs is this downside protection, or is it just the VC's incentive to get a bigger stake? And then again, that's discussion of the valuation. So,
yeah, exactly.
So try to aim for. I mean, 2x, I haven't seen that for quite a while. 1x is very common.
We tried.
Yeah. 1x is very common, with a participating preferred being more and more common also in Europe, because many European companies take funding out of the US, and participating preferred is a very common phenomenon in the United States. And it's very hard to make the A round, and then the B round is going to be with the US investor. And then you have to educate the founders and everyone that now it's a participating preferred. What does that really mean? So VCs also from Europe tend to take that battle already up front to prepare for the next round, because that's going to be there. So there will be some explanations to do there, and that's going to complicate the next round.
Okay, now I'll just throw another stat. In the fourth quarter, 2011, in the Silicon Valley, 31% of the deals had participation, of which 47% were uncapped. So that gives you an idea of what's happening now, at least over there. One other thing that we're not going to talk about, but in the term sheet, there is some discussion of dividends and cumulative dividends.
Nice. Yeah.
And we're not even going to address it, because it's so infrequent. At least in the United States, it's very infrequent. I don't know. 4% of the deals had some kind of cumulative dividend in Q4 2011.
It's pretty common in Europe.
Is it?
Yeah. It's usually the dividend is usually equal to the hurdle rate of the VC fund.
Okay.
So if you want to know what the hurdle rate of VC fund is, you look at the dividend rate.
So you might just explain what that means.
What that means is that as these gentlemen has investors, so have VCs, right? And VCs, they also have to answer to their investors. And their investors require a minimum return before they get into the incentive carry, which is the bonus structure of the VC. And there you have to meet the minimum requirement, which on average in Europe right now is 8%. So usually the dividend sitting in these structures is 8%. That's not.
So what that means is that the liquidation preference is increasing each year by 8%, right? So if it's $1 million this year, then if the company sold a year and a day later, the preference is no longer it's $1 million, it's $1,080,000, and it just keeps growing.
And maybe a general comment is that when you have these sessions without the attorneys, you have to discuss the distribution. And maybe a general comment is that when you have these sessions without the attorneys, you have to discuss the distribution. which can be good sometimes. Ask what the intent is of the clauses that you do not understand. Do not negotiate. In most cases, you will not win that negotiation. Here we have trained entrepreneurs, and they went right into the trap.
Still lose.
Good advice. Try to understand. See if the VC is genuine about what it is, and then thereafter, with the lawyer, you take the negotiation, not without. If you haven't done it multiple times, the VCs on average have done it probably 50 or 100 times more than you have. So it's a difficult balance.
But I can pitch in there. It's like when we had another company, my last company, we sold it off to buyer of Apple, and they did not like the VCs. And generally, the buyers don't like the VCs because they just think they're too well paid. They're coming with all these deals to this company. So they normally take the VCs doesn't know that, but they normally take the stand of the entrepreneurs. And really, what you can do there, if you're smart, you just you use them as a bat against your own VCs. You say, oh, listen, I think you should really do this and this, and I'll be happy to bring it up. So you can, as a smart entrepreneur, you can play that side as well. If you come into the lucky moment of you doing a great exit, and in those moments, the force of the buyer, depending on who the buyer is, can be very, very awesome towards the VC, because the VC is smelling the money. They want to get out of the deal. They're really happy to get out of the deal. So
and if it's a higher profile brand, buyer, that also is a brand thing, of course.
Exactly. So that was a phenomenal force to use for us. I mean, we had all the negotiation power there in that situation.
And I would say that interesting in the TAT deal with RIM, I think one of the negotiation powers we had was that our investor had common stock. So we could, the founders could play good guys and say, yeah, we're fine with this. I mean, absolutely. We think that the valuation is just fine. I mean, we love the company and da-da-da-da. But our investor, poor him. I mean, he's just going to make massive amounts of money. He should have asked for liquidation preference, and we can never get this deal through with him. And he was completely the bad cop in the negotiation, with the valuation, with everything. And we just pointed at him all the time, and he was never in the room. So they were constantly saying, "Oh, could you talk to him about this and that?" And we were constantly referring to him and saying, like, "Yeah." I mean, he's picky on this. So I think sometimes
there will always be renegotiation at the exit. No matter what you write in these things, there will be renegotiation and a balance of power. And obviously all the VCs knows that the acquirers, they look more for the entrepreneurs and management team. So therefore that's why we like auctions, right? Where you have multiple buyers at the table, so you reduce that negotiation power and also get a higher price, obviously. But there's a lot of things that you do, and you start to structure it more and more in also the vesting schedules of the reverse vesting stock. We'll come back to that later, I think. But that's where we take the negotiation power away.
Let's move on to reverse vesting on founder stock, and maybe Jimmy, you can explain what you had in mind there.
Yeah. So reverse vesting. The reason that we have reverse vesting is that now we just discussed we don't need that many stock options because we already have this great team, which we agree. I mean, look at the numbers; it looks good. And the main reason for us investing in the company, outside that boxes in beauty is a great concept,
absolutely,
is obviously because you've done it before, and you are the one to execute on this case. So if you were not there, we would not even invest. And that's why we say you need to be in there for this number of years to be fully vested, because else it's not what we thought it was. So in layman terms, that is why we want the reverse vesting.
And I think that as an entrepreneur, I think that I would say I think that it's reasonable to have. I mean, vesting, definitely. Because, I mean, otherwise you'd have to have super strange compete laws or something that just, otherwise I could quit tomorrow and do a competitor.
Could also be one of your co-founders leaving.
Yeah, exactly. It protects me too. I mean, actually, I mean, it does protect me too. I mean, I like to have some vesting. I think one of the issues here, if we go live, I think one of the issues here is that we've run the company for a while. So I think that our question is on the date on vesting. I think that I mean, if we backdate the vesting start from the foundation of the company, because I mean, we've done this. I've done this. I mean, I did it without salary for 6 months. So I mean, dating the reverse vesting from this investment doesn't feel very right.
So how much do you want to invest up front, or at this time?
How much I want to invest?
How much do you want to be vested now? You say we should.
I would say, I
We
mean,
propose 4-year vesting.
yeah,
Right?
I would say, I mean, 3 years vesting, I think is fine, and I think if you count that from the founding date, I think that's perfectly fine with me.
3 years from the founding. When was the company founded again?
Yeah,
October
2.5 years ago.
exactly.
No, it would be half. 18 months ago.
Yeah.
Approximately 18 months ago.
Yeah, no. That's not gonna work. Not for me. But I could. What you're saying is that you are already some vested.
Absolutely.
It's a fair argument. So, but I think we're looking for a number south of 50% already vested, because you could say, okay, I'm fine with 50%. I'm
No,
already
absolutely.
wealthy and so on. So it's too high a number for be vested up front from this investment.
But would you be okay for doing it from Carl's date? Would mean like 30% vested?
Yeah, then we're getting close to something we could live with.
Yeah,
And
because
then
that feels
and then
fine. I
and
mean,
then a 36 months linear vesting from there
36 months. Yeah,
for the remainder.
yeah,
that
and
be
doing
okay?
it monthly.
Yeah, monthly vesting. So.
Yeah, that would be okay.
Okay, then we have a deal.
Okay, that was pretty reasonable. That went well, but there are some issues under Swedish law.
Exactly.
Are you going to address those? Or?
Well, first of all, I think that the U.S. mechanism is that it's a buyback mechanism that the company buys back the founder's unvested stock, right? I don't think that we would use that in Sweden. We would probably do it in a way so that the investor would have an option to buy the stock, first of all.
An option to buy stock, or
or a right to buy the unvested stock.
I hope it works, because we already have it in Sweden.
Yeah.
But there definitely is an issue with vesting in Sweden, because I mean, if you give people stock instead of salary, or a very low salary, and then that stock is vesting, that means that
But
is
it's what we're talking about here is not employee stock options.
No,
this is founders' shares.
Yeah.
So we pre-agree
exactly,
at this point in time. We pre-agree on terms for us if something happens, for instance, that you leave the company or whatever, that we can buy back shares from you at par value, for instance. And that, I think,
that is a difference.
It's not employee stock options.
Employee stock options.
No, exactly.
So that's just an agreement, right? And of course, if there's a taxable event on that
shouldn't have a tax event.
No.
So founder shares is not a problem.
This is founder shares that you have had since the founding of the company.
Exactly. So
and you have paid. You
paid for them.
You paid for them,
exactly.
Yeah.
and you paid the price, and at a real value. Say 50,000 SEK is the lowest in a Swedish company now. But I mean, the tax issues will arise if you, as you said, if you grant someone options or you sell shares under market value.
Yeah, we bring on a great CMO in Boxes for Beauty, and we want to give that person 3% stock, and we want to have those stock vesting. That problem that 3% stock is now worth massive amounts of money thanks to this investment. That person is going to pay massive amounts of tax, and and not have anything to sell, of course.
He would, well, he would have a problem. She, sorry. Great.
It's Janet.
She was a board member.
Yeah. Active, very active.
Okay.
But she would either have to pay for the shares or the options. I mean, the proper value for it, or otherwise she would have. It would be seen as a benefit.
Well, I think I'm not an expert in Swedish law, but I think what we have seen is that you do personaloptioner in Sweden, and then you, of course, it becomes income tax when you do it, but then you can set the price whatever you want. And of course, you have the problem that you have to pay tax when you exercise, so you don't want to exercise prior to an exit.
But the problem with personaloptioners, I think also is that requires something with payout too. I mean, that requires you can't, if you're a small startup, you can't really do that. I mean, it sort of costs money to start an option program like that.
But we have that structure in 3 Swedish companies right now.
Okay.
With personaloptioner. Yeah.
It's
that
also
works.
because that structure actually resembles more the US structure, and some of these companies are US now, where you have also the same issue, and you have the same. That's why I think, Brad, the secondary issue we talked about. You have already a lot of activity that people buy secondary shares because people that leave companies do not have the money to pay the tax. So there's actually a market for buying those shares or stock options and then exercise them upon the exit of the company. So there's a market for that. At least in the US, there's a market for that already. So, but that structure of personaloptioner is very similar to the US structure.
Now, I'll point one thing out, and it's a similar issue to the stock option pool, the size of the option pool. If the company, let's assume that a founder leaves and the company buys back, 5% or 10% of the outstanding capital, all shareholders' ownership interest rises pro rata. If, on the other hand, one of the investors has the right to buy those shares, then the only one whose equity increases is the person who buys the shares. All the other shareholders don't get any benefit from that. So it's an interesting fix.
Well, you would have a pro rata right to buy it. You could.
All shareholders would have pro rata?
You could.
I see.
In order to get the same, get to the same point.
Okay.
At least you can have the option.
Okay,
to
I
buy
see
it.
your point. So it'd be a rights offering. Yep. Okay, interesting. And that's different. I mean, that's definitely, and it's a big difference. And I think the lesson learned for those in the audience is when you're dealing with early stage companies, the tax implications can be a nightmare, and that's true in any jurisdiction.
Yeah.
I think that's especially true in Scandinavia, from what I can tell. And so, as a plug for the lawyers and the accountants, I mean, it pays here to make sure you have solid advice, right? Otherwise, it could be pretty pricey.
Oh yeah.
Here you really need the lawyers.
That was the sales pitch.
That law changes so many times. I think since I started in this business 10, 11 years ago, it's changed 8 times already. The law for stock options and employee incentive structure. I mean, it's impossible to figure out what's really the up and down in that one.
Let's move on to anti-dilution. A lot of people don't really understand anti-dilution, but really what this is about is, at least in the concept of a preferred stock, rights and preferences, it's a way in the United States at least to protect the investors in the event that there's a future issuance of stock at a price less than whatever price they paid. And there's a couple of key ways you can do it. One is something called a full ratchet, which, as the name would suggest, is kind of a blunt instrument. And it is used from time to time, mainly when the entrepreneurs are getting greedy on the valuation. And so the investor says, all right, you think it's 10, I think it's 5. Let's do this. We'll include a full ratchet. And if it turns out you need to go back to the well and raise more money, then I get whatever the price is in the next financing. So essentially, there's no, other than the risk of losing all of his money, there's no pricing risk. That's called a full ratchet. And in the fourth quarter in Silicon Valley, that was used 3% of the deals. So 97% of the cases, what you get is something called broad-based weighted average. And it's just a mathematical formula. If you look at the term sheet, it'll bore you to tears. And even as a lawyer, I mean, this one requires several cups of coffee and a lot of long-form math before you can figure out how it works. But in a nutshell, let's assume that the price that the venture investor paid is $2, and then at a later date, the company does a down round, and the price now is, say, $1. Then it looks at the total number of shares issued, and there's a mathematical calculation. At least in the United States, the way it works is it reduces the conversion ratio from 1 to 1, 1 preferred equals 1 common, to say 1 preferred now equals 1.1 common. Here in Europe, Jimmy, last time we did this, you mentioned that it actually works a little differently.
Very different.
Which is interesting because it raises, not just economic issues, it actually raises control issues. Do you want to describe how it works here?
I don't know if anyone in the audience got the point about conversion 1 to 1 from preferred to
Sorry.
That's already tough there, Brad, I think. So basically what it means is that at the point of the exit, the way that if there has been an anti-dilution event, meaning that the share price at which I greedy, ravenous bought shares from this company, it's now at a lower valuation, that price is reflected at the end when I convert my shares to common shares to do the participating preferred, which we just talked about. That would convert, so I would actually get more of those common shares at the exit. So it happens at the exit. So it's just a mathematical calculation, so it happens at the exit. In Europe, the most common thing is that the anti-dilution is actually happening at the point of the event. So if there's a new round, shares are actually issued, or it's sometimes structured as buying shares from the founders, but it can also be issue new shares at par value. What that means is that more shares are issued, that each has one vote, which means that it completely distorts the voting power also of the company in Europe, in most cases. So in US, it's purely a return discussion, whereas in Europe, the way it's structured most often, it also becomes a voting problem, balance of power. So you could argue in Europe, it's more if entrepreneurs didn't meet some of the milestones and there has been a down round, you lose more control. That's the common structure.
Yeah. So it's pretty complicated. I get that. We're going to move to the next slide. But if you're having trouble sleeping at night, I find that reading the anti-dilution clause works really well.
Right number of directors. I think that we had a good discussion there the 14th. I think that we feel, I mean, Janet sounded like a great person that sort of you would appoint. That sounded great. And I think that we're after in board, I think we want to make sure one of the founders are there. And I think that you appoint one as a VC. I think that's perfectly fine. We would like to have an independent person. I mean, that would just have like market competence. And then co-select a chairman, which would sort of also be independent, of course. Does that sort of play well with you, what you were thinking?
So can you repeat that? Because I think I missed it.
So 4 people.
Four people.
A founder, Janet from your
founder, would that be you?
Depends. I mean, we've got to have a discussion between the founders. Depends on, I mean, I'm going to be here as a CEO too. So I'm going to be in the board in that sense too. So, and then finding an independent who sort of bring on market knowledge in general. And then co-select the chairman that we find sort of.
And then the one we choose.
And yeah, as you already, I guess, appointed Janet there as your.
So I'm not on the board. You only want Janet.
I mean, we could one founder, one VC, one independent, one co-selected chairman. Is that what you're saying? You pointed 4, so maybe we should get fifth on there.
We could, I mean, adding you on, of course. We think, I mean, one of the reasons we're sitting here, one of the reasons we're sitting here is actually because we think you bring a lot of competence, of course. So, but of course, adding another, would that feels only right? I mean, to add another founder. So two founders, Janet.
So now you want 6.
Yeah, it feels hard to change. I mean, the problem with the independent we're having is how independent is the independent? I mean, you're pointing to people that you find are good, and how do we know that they're not in other boards or are linked to you somehow? I think that's a good idea, actually.
Okay.
To have Carl as the chairman.
Okay.
Independent.
Thanks.
Yeah.
You're pretty rude here, you know.
So
you don't want me in, and you don't want your chairman in. So.
But one VC, it's one from your side, one independent, one chairman. That'd be good, wouldn't it? That'd be enough. 3.
We want to elect 2. With this size of investment, we would like to have 2 members. One will point. We always sit one of us on the board, and then the other part is always one where we go for the brain. I'm not the brain, sorry. So
you got the woman. You got the beauty.
The Janet. That's why I'm investing in you guys. I mean, I thought it would
a cosmetic company, of course. Yeah, that's true.
So I'm the only one in my company doing investments in beauty. So.
Okay.
Yeah. So Janet would be there. I would be there. And then we find an independent on which we agree. I mean, you can also appoint members.
So it's co-voting.
Co-voting, that's fine. And then it's one of the founders.
Yeah.
And then it's Carl as the chairman. How about that?
Yeah, and probably not some of the other founders, and I'm going to be as CEO, right?
Well, that's why I asked who of the founders is going to sit there. We don't want in this size of company, we don't want 6 people on the board, I suppose. Isn't that a little much?
But if I get it right, you want to appoint 2 people.
Yes.
On the board.
Yes.
So there will be, and then me as a chairman, then you, the founders.
And you are
have
also
one,
a shareholder in the company. So.
Yeah, small. Yeah, exactly. So
Small.
founders will have but founders will have one.
Yeah,
and then Hampus.
I mean, one of our fears is that it's going to be a board of a lot of investors and not a lot of sort of operational people.
I'm the only investor. Along
Yeah, but
with
I mean, Carl is also exactly. So I mean, giving
that's
as
only
a
2 out of 3 or 5. That's still
yeah.
more people that are not investors. That's good spread.
I would suggest as a small company, I think 5 is this is general speaking. I would say 5 is too big, too many for this kind of investment. I think that if you want to move it very fast forward, you want to have some. Perhaps the VC will appoint 1 person. We have a strong knowledge person, call it independent.
We always sit on boards, so you don't want Janet in.
So, but
I think, but if you say Janet, or you want to do yourself, but if you want it, I mean, if
we can have Janet as an advisor. Actually, we could put her in an advisory board instead.
True, that's a great idea.
So we could have 4 of us. I mean, 3 of us, and then an independent.
And how is then the chairman elected? If that's not Carl in this case.
I think that we can start by electing Carl, but then we'll definitely. I mean, if we're having re-elections, that's going to be we're sort of co-electing.
No, that doesn't work for me.
But the chairman has a sort of determining vote.
If we only have 1, we want to have at least to have some control over who is the chairman.
So,
but you're minority shareholder, aren't you?
So are you. You're a chairman.
But
so
should we appoint you as chairman then?
No, that's not a good idea. Not a good idea. Bad idea.
Rats.
No, I don't want to be the chairman. No.
Okay. So.
We have a discussion whether it should be 4 or 5.
Yeah, and that's actually a very valid
I think
discussion.
5 is a good balance. 6 is too many. 4 would be okay if we put Janet advisory board and so on. But usually, with her kind of name in the business, I think it would serve you well as a board member. To be honest.
Yeah.
But I would be fine for her being an advisor.
It's okay. Let's put it in their board.
So, but then it's 5.
Yeah.
And then
I'm okay with that.
Okay.
Yeah.
So then we agree.
3 would be better size, small size.
Yeah, 3 is probably good for the very beginnings. 3, 4.
Yeah.
The small.
Would you agree to that, though? If you put $3 million or 3 million British pounds in, and you got 1, would you be comfortable with?
I would be comfortable if we can assign 1.
Yeah, exactly.
Founders and combined, these gentlemen can assign 1, and we then co-vote the chairman. That would work.
Are you on 3 now?
No,
Yeah.
we're 3.
Yeah, exactly.
Only 3.
Yeah.
3. Okay, one other thing that Hampus mentioned, I know we didn't end up there, but you let's assume that one of the other co-founders was, quote, going to sit on the board, and you as the CEO weren't going to sit on the board. You know, obviously you need to go and present reports to the board. You know, what are the pros and cons of that?
I would say my experience is that it's not in the board, it's not that much about voting. It's about the discussion. So if you get the CEO and the co-founder, that actually means you kind of get 2 on the board. Because, I mean, if the CEO is a founder. So, I mean, because the discussion, there's so few times when you actually throw out the CEO and have a discussion. And there's so few times when you actually vote, hopefully. So if you get the CEO and the founder, that sort of gives sort of a much better discussion. At least, I mean, that's my personal experience. And I would say, as a personal experience, I would never do what actually, one of the things I suggested, I wouldn't put more than a couple of founders in the board. Because one of the issues I've had historically is if you have founders in the board, the problem is the founders have to separate themselves as owners, operational, and board members in the brain. And that's super complicated because people are discussing their money, their job, and sort of a strategy of the company.
I agree with that. Usually what we see is that either founders elect one that's independent but that they trust, but someone they trust, or they and then the CEO is there also. But usually in board meetings, it's rarely a good idea to have more than the CEO in the room of the management team, because founders are also the management team, because that could be a discussion about, is that team member performing well or not. I mean, the board's role is to hire and fire the CEO, and the CEO's role is to hire and fire the team, right? So it can be very complex discussions, and suddenly are you then the board member, the owner of the company, or are you an employee in the setting?
Should we start a Brazil office? I mean, in this case, might be very connected to one of the founders being very interested in living in Brazil. Yeah. So putting that founder in the board might make a big issue.
I think we have to be careful about putting. As a VC, you prefer to see that the founders really say, okay, we have elected
one person
Hampus as a CEO, and they have done that historically for a reason. So coming into the situation, just coming from outside, you would assume that there have historically been some reasons why Hampus was now elected as a CEO.
But a warning, also warning, now we're doing with just one VCs, but common could be that you co-founded. I mean, you co-invested with a couple.
We have a farm out, right? So
so you can co-invest with several other ones, and then it's getting really complicated because everybody wants to sign somebody on the board, and they say, we need to have somebody on the board, but they still like to co-invest. So they all depend on each other, and you should.
But you should still aim to be only at 5.
Exactly, even if you have to. And that's the hardest thing, because they're all going to fight for being on the board.
Yeah, so but then you would have each of the VCs each appoint one.
Exactly.
And then the Janet would be then the advisor or whatever.
It could, and it could,
But I think, I mean, this is also different from different VCs I've seen. There's a bit of philosophy and control issues here. Rarely what we try to aim at Sunstone is really trying to say, okay, at this stage we really want a balance between that of the founder team and the VCs. We don't necessarily want to have any direct control over the board, to be honest. That's not our goal. And suggesting that I should be the chairman as a VC is really not a good idea, and also VCs are down the road. There can be different incentive structures, and as the chairman of the board, you have a mitigating role between two camps. And how can you have that mitigating role in two camps? And I am chairman right now of a couple of companies, but it's not the best thing. I would really recommend that the VCs are not taking that position.
We're taking off the board.
Yeah, I think we take him off the board after that.
Now, one thing that I've noticed that's a little different here in Scandinavia, in particular, is that sometimes you'll find boards that consist solely of non-executive members, and then you have a management team. So it's not always the case, apparently, here in Scandinavia, that the CEO always sits on the board, which is different than what I saw, at least in the United States. Do you guys want to address that issue?
Yeah, but I think in the US, almost per default, the CEO is also a board member.
Right, I agree.
And in Europe, that is rarely the case, though, that the CEO is mostly present, of course, unless we discuss the CEO's remuneration or potential firing. He's not in the room, but aside of that, he's there, but formally, most often not a board member officially. Usually what we see is founders elect someone, or the angel investor then represents the common shareholders combined, or it's an independent that is elected by the founders. I have seen structures where it's another of the founders, and I have to agree with Hampus. That hasn't really worked well, I think.
Right.
Okay, last issue would be, if there is an outside, not an investor, but a true independent director, how would that person typically be compensated?
The outside?
Yeah.
The outside director? Well, in the US, it's done with a ESOP program, so stock options only. And I think it's pretty common. It's 25 basis points of the cap table. So it's 0.25% for a board member and 0.5 for a chairman. I mean, ask Wilson Sonsini or whatever, they will say that is kind of standard. Yep. No cash. Whereas in Europe, it's all over the map. There's no common practice, I think. Depends on the profile, and I think it's always a combination of stock and cash, is what I've seen, mostly. most VCs would not come with direct experience in this particular field. I mean, they would invest in different things, and there you might want to look at which VCs are you then looking for. Have they done similar investments in beauty before, like in this case? And if not, maybe Ravenous is not the right VC for you guys.
Probably not. I think for other reasons too. I think
But
they're a hard negotiator.
It could take up a lot of time with the board and all that, but it's I can understand from the VC's counterpoint, but I think it's a little bit over-recommended sometimes with a small company, depending on what size it is. It's like the board's role. If things moves in 180 kilometers an hour, I mean, the board's role in some of those decisions is like nice to have their opinion about it, but they're hard to catch the company as the company's moving so fast.
There's a lot of early stage companies where we officially have a board.
Yeah, but
exactly. You're out of it.
No, exactly.
It's not corporate governance in the traditional sense.
No.
It's just getting the job done.
And depending on if you get the wrong side of the board member, a board member that's very traditional, extremely traditional, that could be, take a lot of time.
Well, you definitely in an early stage, you definitely want to start up board member, which is okay with having paper board meetings that never happened and sort of stuff like that, and being agile and realizing
most
that
of the discussions not happening in the board meetings.
Exactly.
It's happening
exactly
outside.
Boom.
I agree.
Okay, so let's try and get through the rest of these. There's 5 more points: protected provisions, drag along, redemption rights, rights of first refusal, and a no-shop confidentiality. So in order to make sure that we can get back to the bar sooner rather than later, or to allow people to get home and see their family, let's spend about 3 minutes or 4 minutes on protected provisions. So I'll let Hampus and Carl indicate why that might be an issue. Yeah, it's right here.
Maybe the attorney should help them find it.
Yeah, exactly. This is why you have attorneys.
Maybe they should have brought their
attorney. So
exactly.
on page 8, just in a nutshell, there's a whole laundry list of things.
That's what I feel. It's a laundry list.
We only put in the 8 things that is common. So the first one tells, just for the audience, right? The first one tells that you cannot sell the company without our consent.
Yes.
That's okay.
Okay, so 1 down. Then you cannot change the articles of association. I think you call it something different. Bylaws and certificate of incorporation without our consent. I think that would be okay too.
That feels very sound too.
Okay, great. 2 down. Then you cannot issue new shares without our consent.
I think that feels like it could be an issue. That feels like that depends on the valuation.
That depends on the valuation.
I mean, if it's higher than the valuation you invest on, it feels like we would be able to. You wouldn't be able to veto that.
So what do you suggest instead?
I mean, I've actually, this is a real life experience. So that's why I've seen this. That I feel that you want to have been in a situation where if the valuation is higher than when the VC invested, the VC must accept to do another round.
Yeah, we can discuss that. So what do you think? It should be a little higher than just what we invest at.
30% higher.
Okay.
Now we're being hunted by these guys, so it's frustrating. Please continue.
And then you cannot redeem shares, pay dividends. I mean, we are here to make a growth company.
Absolutely.
We're not
we don't
here to
want to
get
pay dividends at all.
Okay, so we agree on the 4th. And then you cannot go out and indebt yourself.
No, we don't want to do that
either.
either.
So that's 5. So 6, you cannot invest in new subsidiaries, divest subsidiaries and other assets without us letting us know. I mean, it's a substantial
if
business.
it's less than, that feels okay too.
Okay, good. You cannot, great invention that you have, you cannot license that to others so they actually take array rights and so on.
No,
so
that's okay.
Okay. And then you cannot increase the size of the board.
You skipped the hire and firing, but that's okay too, actually.
Hire and fire.
You skipped the 7.
Which one?
Hire, fire, changed the compensation of the executive officers. But it's okay.
Yeah, I think that's okay.
Yeah.
And then the last one is that increase or decrease the board, which was one we just agreed.
Yeah, exactly. So that's okay.
So
I think the main thing is issuing of shares, actually.
Okay, so then we agree. So 7 out of 8, you agree.
Yeah.
Okay, cool.
All right. So one of the things that it's important to recognize is the board of directors obviously has power as the board, but in this case, you can't do any of those things without the approval of the investor. So it gives the investor some additional protection, control. So let's go to the next slide. This is an interesting one, and it was raised earlier, which is the ability to force the sale of the company. So I guess Hampus,
Be happy to receive.
it's called a drag-along, right?
Yeah. And drag-alongs are, I mean, generally okay. I think that.
But is it drag and tag along?
It's drag and tag along. This one, right?
Is it tag along?
It's a drag along.
It's not tag along?
No, that's different. Drag-along means essentially they can force
They can force a
the
sale,
company.
exactly.
Drag along, we can force the sale.
Yeah. So that depends on the valuation, of course.
And we can't tag along on that. If you drag us, we can't tag. We're not allowed to tag along on that. Is that what you say?
No, we drag you. You
No,
will
you-
sell.
Exactly.
Okay,
will
we
be-
must. Okay,
You
so we
must
couldn't.
sell.
Okay,
Yeah, exactly.
Yes.
So they can sell to a fire sale
exactly.
valuation.
Yeah.
So that, of course, again depends on the valuation.
Okay.
And
what's
the
the
liquidation preference matters here.
Of course. I mean, they can sell so that they get money, but we don't get any, and they can just.
Is that fair? You think that is that your opinion that you should be able to drag us towards?
So the reason the drag along is there that our fund lifetime as a VC is usually 10 years.
Mhm.
And
How long
you've promised we are investing out of a fresh fund.
Nice. That's
But
important.
You promised in your plans that you would do an exit in 5 years.
Yeah. And I think we're fine
We're
with
aiming
saying,
for an exit in 5 years, but
but I think we're
is it-
fine with using the funds. I mean, we can have the funds lifetime. I mean, 10 years feels okay.
Well, you
10
don't want to
years
depend
is
on
not
it.
good enough.
Sorry?
No, 10 years we cannot do.
Why not?
No, it's way too long.
But you had a fund lifetime of 10
It's
years.
the fund
But
lifetime.
average holding period is not 10 years. It's 5 years.
Your average holding period of the fund is
Average holding period of every investment is
okay,
5
but the
years.
fund is 10 years.
Yes,
So
but
should
we invest in a number of
should
companies.
this be activated after 5 years?
I think we should go back to discussing the model that you had around the price.
The model that we had around the price.
Yeah.
Sorry.
So what valuation instead of time? Look at the valuation. You said if it's a fire sale,
Yeah,
we
exactly.
could trigger the
sorry.
exit.
Exactly.
I mean,
yeah.
that's the real problem
Yeah,
also in
exactly.
respect of your
Yeah.
issues.
Yeah. So,
So
what
maybe we should discuss what price level would it be fair and say, okay, at this level we think it's okay. You know.
I think that I mean below what you're investing in, I think that you shouldn't be allowed to do to force a sale.
Oh, that's fair.
No, but it should be. You can't.
No, hey, sorry, below.
You
we
need to
liquidation
do
preferences.
X
exactly.
times. So you have liquidation preferences of 2 times.
Yes.
Is that what we negotiated in the final? So it needs to be way
would be-
above that in order for us to
if it would be
get
4 times
compensation of us having ownership of 42.4%, which is the founder's shares. We need to have full compensation. I mean, we need to have at least one-time compensation before that happened.
And what is that one-time compensation?
I mean, that would be one on your investment.
So let's say
The valuation of your investment.
okay. So let's say that that the pre-money was full diluted 6. Now we reduce the option pool a little bit, so maybe a little higher. We haven't calculated that.
Yeah.
And then post-money is 9. So should it be at what, 15? Or?
If it's a 15 and
No,
you have
they-
a 2x
they-
return,
that
then
doesn't work.
But that still gives you 1, right?
yeah, but
But it doesn't if you get 2 times.
yeah,
Well,
but
I get
it does.
6.
If they get 6,
Okay, so you get 12, so
exactly.
you get 15. Nah, we think we need to have more.
20.
Okay. 20 is a good number. That's fair.
Is it really actually? I would be very scared about this.
Come on, it's not fair, man.
I wouldn't say this is good. I would say actually it's not a it's
It
not a best
sucks,
deal.
man.
Exactly. If you think about it.
We're looking at 3 minutes here, so
Okay, sorry.
Okay,
I
20
wouldn't
it
do
is.
Okay. We wouldn't do 20.
No.
No,
we
we,
need
we will never do 20. So
But and we are going to move on. But the issue here is that there is this concept where there's there's something you can negotiate for as an investor,
Yeah.
a drag along right, and obviously it's not in the VC's interest to try and liquidate the company at a 2 or a 3x
No, of
if
course.
they believe they're going to get a 10 or a 20 or a 100x.
But do you ever see that if you drag, then you would convert to common?
But only mathematically you will convert.
Yeah,
You will
okay.
make the
So it
math.
doesn't really matter. Okay.
It doesn't
no.
matter.
Mm.
It's
Okay.
the conversion to common is, unless it's the IPO, which is very different. We are not going to discuss that today, I think.
No.
okay.
I will
Okay.
say one thing that I saw in the post.com bubble, at least in Seattle, were some like late stage financings where maybe it's a Series E or an F, where the new investor comes in with a multiple liquidation preference, like a 3x, with one of these drag-along rights, and then forced the sale of the company where they got a 3x return and everyone else pretty much got very little, other than, of course, the management team who stayed on. They got a carve-out, so on and so forth. So I think with the Series A deal, it's unlikely to come into play, but as these deals add more and more series, it becomes really an issue among the investors as well. So the next one is an interesting one, right of first refusal and right of co-sale. And I'm curious, Carl, how do you feel about this one?
Well, how do I feel about this one? Generally, if in Sweden, I would say this is the same as hembud in Swedish, isn't it?
Yeah, exactly. Which is a good thing.
Which is a good thing. I mean, generally, it's a very good thing. If I've interpreted it right of first refusal, co-sales.
But
so
it got to be anybody. I mean, it's got to be mutual. So it's got to be that we can buy. If you're going to sell your stock, I can buy your stock. It's not only the VC. I mean,
but why? If
that's not how this is drafted.
Sorry.
That's not how this is.
Exactly.
No,
So we're not happy with this. We need to change it to Swedish clause of hembud. Do you understand that? Is that okay, buddy?
Someone delivering food to your home? Or?
Yeah, exactly, exactly. No, we like the concept that people can't step off. I mean,
but you are now a Delaware company. You're not a Swedish company anymore.
Yeah, we would like to take that out of Delaware. That sort of right of first refusal.
So let me get it right.
Yeah.
You want also the right of first refusal, and you're asking me for a lot of money.
No, but I think that.
And if we come to the next round, and you want also the right of first refusal, just explain me how you're going to raise the money to do that.
No, what we're after here
because
is...
then I missed something. Maybe you won't.
No, what we're after... We think that a right of first refusal is an okay concept, but what we want to end up in also... What we don't want to end up in is that there might be a secondary market for the stock. And the founders, well, conceptually don't have... I mean, this is 99.99999% of their all their money, of course. And you can sit there and see that, well, an IPO in 3 years might be a good time. And we can't buy a car or whatever with our salaries. So if we can carve out some amount and be able to sell that, for example, on the secondary market, that would make us much more comfortable. Personally, if I would be on thinking of all my founders as well, I think that I would be like to have that like after 2 years. That after 2 years, I'm seeing as like conceptually vesting, that after 2 years people can sell on the secondary market, but not before that, to make sure that people are...
And how much of your holding?
15%? I would actually be okay with that.
15 is a little high.
You think so?
Yeah.
I mean, looking at the next round, 15% might not be much.
Well, I hope so. Because you're going to increase the value of the company, right?
Yeah, but who knows what the secondary market looks like.
But it's pretty general. We want to take something off the table. You should be able to do that as the founder of the company.
But I'm just arguing that 15% is a little much.
So what do you feel? What is...
10?
12 is okay? I'm fine with that.
Tradesman. We can do 12.
Yeah.
We can do 12%. And that's for you and the other founders, not this guy.
It's for the founders. I mean, he's got a lot of money.
No, then we're totally out of this. So we need...
It's only founders, right?
It's okay with me that Carl...
He has money.
Yeah.
I can be full. I think this goes for the founders. I can fully sell him in the second round or sell my 100% of my shares on the market. Being an angel.
That would actually be okay with me too. That it's the operational people we want to make sure that they have a focus. So the angels could sell. I'm fine with that.
So maybe in this clause we could include you as the one that has some of the rights of co-sale too. Is that what you're saying? If you accept that,
yeah,
we would be okay with that.
Yeah, I would be okay with putting him in sort of the investor seat.
The co-sale right.
Yeah, exactly. So the founders have a 12% carve out that they can sell.
Yes.
So yeah.
And Carl can sell all.
Yeah, exactly.
So this is an interesting one, and I'll read a couple of stats that I just pulled. In the United States, in the last 3 or 4 years, there's these secondary markets that have emerged, which is a market. They're online bulletin boards where you have to. I'm actually a member of one. You have to be an accredited investor and a sophisticated investor, and if you are, then you get. Basically online auctions of shares that are available for resale. In second market, which is the market leader right now, apparently completed 558 million in transactions in 2011, which was a 55% increase. Of those, 80% of the sellers are ex-employees. So ex-employees of companies that want to, get liquid on some of these privately held shares are using it. Millennium Technology Ventures, which is a firm based in New York that was one of the pioneers in this space, they published a report that said that they believe that this will be a $10 billion market by the end of 2013. And if you compare that to the size of the market for IPOs and M&As combined, which was $53 billion last year, it was a pretty good year, you can see that this is starting to become a fairly big deal. It used to be you either had to go public or you had to be acquired in order to get liquid. Nowadays, there are some other ways for people. And it's not just ex-employees. It could be angels. It could even be VCs. VCs that have decided for whatever reason that they don't want to raise another fund or they can't raise another fund. Their limited partners might want to try and get some liquidity. So that's what's happening. And so all I would say is this right, which used to be universally agreed to without much negotiation, is something that's becoming a little bit dicier. Let's go to the next slide. Last point in this term sheet. So you're going to go out fighting like a Swede. Let's do this.
Well, yeah. So Jimmy, we came in. I would say I think Hampus is really pro. Sounds ravenous and ravenous. But we had along
hungry bastards.
Exactly. We've seen some great term sheets from you guys. And some things we're not going to be happy with. So and we also had fine discussions with a couple of other VCs. So do you think we need to go back? Some of these things we're not going to take with you, and I think some of these we're going to renegotiate with you later on the stage. But in order for us to sign a no shop, we think that some of these terms really needs to be settled for our side, for the better for our side.
The term sheet is valid for still 7 days.
Exactly, 7
and
days.
from thereafter, I will walk. Period.
So it's only 7 more days, is
yes.
it?
So you can negotiate all you want in 7 days.
So you think that you want, but no shop in 7 more days is.
You can shop all you want for 7 days.
Okay, that's great.
And then when you sign this term sheet, there's no shopping. I think confidentiality is fine. If you sign something and it's confidential.
Are you okay with that we both have a focus to try to sort of sign the real agreement and say that after we sign the agreement we have 30 days of no shop, so that we make sure that we focus on getting.
30 is not too much to do my due diligence.
30 is not enough to do your due diligence.
No, 8 weeks we ask for.
Why would you want 8 weeks to look at our company? Would it take you so long time? I thought you understood this pretty good.
Well, I don't know. I understand that well. There's a lot of things we need to do.
What are you concerned about?
I'm especially concerned about you two guys. That's going to take a bit of time. Yeah. Maybe we can do it in 6 weeks.
Yeah.
That's quite common.
6 weeks.
Yeah,
Jesus Christ, 6 weeks. Well, we can establish ourselves in a new country in 6 weeks.
Flanders, we will be in Flanders in 6 weeks.
Jeez, okay, so
that's
maybe we can sell for 3. Is that okay by you?
No, that's not long enough.
No.
Sorry.
But what we want is focus, really, to make sure that you don't sign this agreement and then you start looking at other agreements and you don't really give us focus. So making sure. No, I mean Ravenous, making sure that if there's a. I would
we will sign more agreements in.
Absolutely, of course, absolutely. But what I want to make sure is that there's a constant progress.
Sure.
If there would be like a week with nothing happening.
Okay, let's do it this way. Let's look at the due diligence list.
Yeah.
And then say here are the first fairly important items, and then we check mark them off. And if we already at that point can say this is a no-go for us, then we still have 6 weeks. But if something comes up in the process, we can checkbox them off.
Our experience is always things comes up. Things can always come up. It doesn't keep us focused.
But what I would say, I like the idea of saying, let's have the list of due diligence items.
Yes, and then we inform you.
But let's say
you can see the progress report.
Exactly. Let's say the progress report, and let's say that we'll put a timeline on those.
Yeah.
And if you don't reach the timelines, we can shop.
Yeah, but usually what.
So if you haven't done the HR due diligence in 1
fine.
week,
that's
then
fine. Of course, I assume that you will be available.
of course.
Okay.
Full focus from our side.
But it's that could be okay.
Yeah.
But what we could usually what it takes is usually 4 weeks of due diligence. We can handle that with 4 weeks. But then the attorneys they always want 2 weeks to do the
drag your feet,
all the documentation, right? And we don't want to go to the documentation phase and spend all that cost before we have done our due diligence.
So 6 weeks, and then putting a progress list.
Yes.
So if you're not at a point,
Yes.
so if something's happening, we can talk to others.
Yes.
That's
Give a
okay
breakup.
with me.
Okay.
Yeah.
Six.
If we don't meet, then we need to discuss how
Of course,
that
the timelines, of course.
But it's
Yeah.
going to be a list, and we'll do these things. And
Yeah,
that's
I'm
fine.
fine with
So
that.
6 weeks.
Are you going to throw in a breakup fee?
I was thinking we need a breakup fee here. Yeah.
Oh man,
6 weeks we need a breakup fee.
a breakup fee.
Yeah, that's common. I mean, a lot of the VCs we talked about, they offered a breakup
Yeah,
fee.
in all our term sheets we've seen so far, been thrown at us, we've seen a good breakup fee.
It must be because you have something in beauty.
Yeah, exactly. It's the beauty part of it.
I have not seen it in the last 10 years.
No, exactly. We're fine with it. It's Carl. He's unrelated.
So who is it that offers that?
yeah, we can't talk about. They've got
They're
a
confidential.
Exactly.
Okay, yeah, sure. But you didn't sign with them, right?
No, not yet.
Okay,
No,
yes, you
no.
couldn't talk with me.
Exactly.
Okay.
So they're not that secret.
So 6 weeks, 6 full weeks.
6 full weeks. I'm okay with that. If we keep a strict timeline to make sure that they're dedicated, we can put the
4
timeline.
weeks
That's
of due diligence, 2 weeks of the
legal.
lawyer stuff.
Exactly. Think of that. What's 2 weeks of lawyers? That's like 1.2 billion. I mean, you don't want to go.
Is that right? That's right.
Yeah,
1.2
yeah.
billion. That's right. It's more.
Depending on what lawyers you use.
It's more than the investment.
Yeah, exactly.
It's going to be the investment.
That's
That's why I
common.
want to cap it.
Exactly.
But you have seen that it's the company attorney that's going to draft the documentation. I assume you've seen that.
No.
Okay. Anyways,
Yeah. What about payment of the investors' legal fees? Is that okay?
They're gonna pay for those, of course.
Yeah.
We're gonna pay for our legal fees. They're gonna pay for their legal fees.
No. No, the
And
company,
we-
the term sheet
Exactly.
says-
We want to bring that out. We want you to pay separate. Pay for your legal fees out of your funding, 2.5% from your funding, and we pay for our legal.
and you don't want to pay for the due diligence cost either? I mean, that's
No,
fair.
of course, that's your cost. I mean, that sounds.
So that's
That's
but
your
the other
cost,
one
of
is
course.
also our cost.
Yeah, absolutely.
So we
So
put a
your
cap on due diligence cost, and then we pay our attorney fees.
You paid out your.
You pay your due diligence fees. You pay your attorney fees.
No. Due diligence is paid by the company.
Why?
As suggested here, and also it's suggested that the other fees, our legal fees, will be paid by the company.
That's.
But and that's
So
out
now,
of
That's-
now I'm
that's-
suggesting,
we
now
thought
I'm
that was-
suggesting that we split it.
We thought that was a British dry joke, actually.
Yeah,
so
so-
we just sort of.
So and that's out of question. We think that
Black
you
humor,
need to
you mean?
you need to
Exactly.
you need to put a leash on your cost from the due diligence side. That's up to you how you do that.
No,
we
just
won't
want
carry
to put
anything.
in. No, we are not going to spend ridiculous amount of money on that if we can avoid it. What we want to do is that the company, after we have made the investment, pays the amount. If we don't make the investment, we pay it. But if we make the investment, the due diligence cost is paid by the company. Out of our money, by the way.
we split
Yeah,
it
exactly.
50-50.
No, we don't split 50-50. We pay our legal fees, and you pay the due diligence cost if we do the investment.
And we
Else,
cap it. And we cap it.
We can cap it.
Yeah.
We can cap it, yeah.
Yeah,
Okay.
so we can cap it at 250,000 pounds.
Are you using Moll Wendén? They're really cheap, actually. Moll
Well,
Wendén
that's
are
not
really
the
good.
legal fees. We pay them.
Oh, sorry. Yeah,
Oh, that's
there-
true.
And that's not happening.
I mean,
But
looking at the size of
Okay.
investment, that's a pretty crazy amount. So
Yes, I agree. Okay, so let's say 100,000.
50,000,
Top. Let's do that.
3 minutes.
we cap it at 50,000
Yes.
due diligence,
Yes.
including legal costs.
No. We pay the legal cost for
Okay.
our own side, and the company pays for the material for this.
If the investment
transaction.
goes through.
If the investment
No,
goes
no.
through.
If the investment, well, they pay for that anyway.
Oh, okay. So no, we won't. No, there's no way we will pay for it in case the
If the
investment doesn't
investment
go through.
goes through, you
But
said
it's
you
your
would take the
company
bill.
counsel. Why should we
Doesn't
pay
matter.
your company counsel?
You would pick. You said.
Doesn't
you just
matter.
said that you would pick up the bill.
the
That-
company is paying for that.
It's a
We
simple.
don't know if
but we are founders.
if for some reason don't
No,
want to sign the agreements.
No,
why
but so
should
we are
do it?
founders. You are created a financial vehicle. That's what you do. So you need to pick up that bill in
No,
case it
no.
doesn't go through. So that's your business.
not-
We
not-
as founders, we're creating a company.
We are not in the business of picking up lawyer bills.
No, we're not in the business of that either.
No one really is.
No,
actually.
nobody.
Who is
Nobody
in the
is.
business of that?
No deal.
Maybe we should cut it off.
Yeah,
here.
let's cut it up there. I will say
Now we have been talking about the lawyers.
in the
promised.
United States, it is customary for the company to pay the legal fees. Usually, it's
Also in
capped.
Europe.
I don't know if that's customary.
Also
here.
in Europe.
Yeah.
We refuse.
Which is a little bizarre, but it is what it is because you're essentially paying somebody to beat you up. But
Yeah.
but in any event, that's really all we've got here. Do you want to go to the next slide? So I just want to say thank you to everyone who put this together. David and Helena in particular put a lot of time and energy into promoting it, organizing it. All of the sponsors, obviously, Moll Wendén, MINC, Startup Bootcamp. Let's see if I'm Sunstone, obviously, for giving us Jimmy, so I hope everyone here learned something tonight.
All right. I don't know if we've seen two Swedish guys getting played by a Danish guy.
Yes, as always.
We now know why you should never sign a term sheet without your lawyers. At least you go back and you discuss this lengthily. And I just want to say thanks a lot to all of the participants, all of you also. I hope you've enjoyed it. Thanks mostly to the cast, of course. Thanks a lot.
Thanks.
Wow.
Need champagne.